Welcome to The Agent's Advisor, theagentsadvisor.com, our weekly webinar series where I bring to you a webinar every Tuesday at 10 a.m. and 2 p.m. Eastern Standard Time to go over a topic that affects how we do business, that impacts how we do business, and will empower you to do more business. So we're hopeful that today's webinar will be just that. Today's webinar is talking about the IRMAA solution, how income affects Part B and Part D premiums. Before I get into today's webinar, I want to take you to our website at theagentsadvisor.com. If you have not been to our website, please visit us at www.theagentsadvisor.com. Take a look at our website. As you can see here, we have plenty of tabs to click on, great information within those tabs, but if you scroll down onto our website, you'll find some additional information there as well. The Agent's Advisor, our goal is to empower independent insurance agents. We are an SGA FMO with a number of carriers. We work with independent insurance agents around the nation that sell health insurance, Medicare, life insurance, and annuities. So if you're looking to make a change, if you're looking to consolidate who you choose to partner with, we would love to have the opportunity to talk to you and welcome you to the Agent's Advisor, theagentsadvisor.com. My name is Joe Morris. I'm the CEO of the Agent's Advisor, and I'm coming to you today live from our office, our corporate headquarters in beautiful downtown Noblesville, Indiana, on the square. We're broadcasting live from our Advisor TV, Advisor Radio studio here in our corporate office, and we're going to be bringing to you some content today that will affect your clients. So let's go ahead and get started with this. What I want to do is open up a couple pieces here, and I want to talk about the 2018 Medicare amounts. What those Medicare amounts are. Those will include Part A hospital insurance, Part B medical insurance, including Part B deductible, as well as Part B premiums, and talking about Part D prescription drug coverage and premiums. So for that, I want to get into just the basics. We'll start this off with the basics, and that is Part A hospital insurance. Part A hospital insurance includes the Part A standard premium, and there's no charge for most people who have worked at least 40 work hours, or work quarters, excuse me. So there's no charge for most people that at least work 40 work quarters. For those that work between 30 and 39 work quarters, the monthly premium is $232 for Part A. For those that work less than 30 work quarters in their career, their Part A premium is $422 a month. For Part A late enrollment penalties, if you aren't eligible for a premium-free Part A and you don't buy it when you're first eligible, your monthly premium may go up 10%. You'll have to pay the higher premium for twice the number of years you could have had Part A but didn't sign up. Your cost associated with Part A for each benefit period, you'll have a Part A deductible, which is $1,340. That's your portion. Your hospital inpatient stay for each benefit period is as follows. You'll pay nothing for the first 60 days. You'd pay $335 a day for days 61 through 90, and you'd pay $670 a day for days 91 through 150. That's lifetime reserve days, so the 150. After you've had 150 lifetime reserve days used, all costs for those days thereafter are 100% your responsibility. When I say you pay as if you're the Medicare beneficiary. Skilled nursing facility stay, home health care, and hospice all have amounts that Medicare will pay under Part A, and then there's a portion that you would pay. So for skilled nursing, you would pay days 21 through 100, $167.50. All costs after the 100 days are on you. That's your responsibility. Home health care, no cost for home health care services. There's a 20% of the Medicare approved amount for durable medical equipment. That would be your portion, 20% for medical durable equipment. For hospice, you pay nothing for hospice care, and there's some additional language in there. Under Part B, under the Part B medical insurance side, so again, you have the hospital side under Part A, that's the hospital charges. Part B are the medical insurance charges. So your Part B for 2018 is $183 per year. The Part B coinsurance, after deductible is met, you typically pay 20% of the Medicare approved amount for most doctor services, including most doctor services while you're a hospital inpatient, outpatient therapy, and durable medical equipment. So the 20% is where that comes into play. Your Part B standard premium, the standard premium amount for 2018 is $134. Now, it will go higher depending upon your income. However, some people who get Social Security benefits pay less than this amount, typically on average $130. So if you know somebody that's on Social Security, they may pay less. Now, since 2017, people with Medicare with higher incomes, they've paid higher Medicare Part B monthly premiums. These income-related monthly adjustment amounts, called IRMAA, affect roughly about 5% of people with Medicare. So today's purpose of this webinar is to talk about IRMAA and to look at the cost of IRMAA and talk about it. And even though that when we get into some of these examples, we're going to be talking about really those, a small percentage, meaning less than 5% of people on Medicare actually pay an IRMAA. But if you're in the market and you're looking for new markets, I want to show you some ideas that I have about that. So let's take a look at your Part B premium for 2018 based upon your 2016 return. I want to get into that. So when a person turns 65, what they pay for their Part B and Part D premiums is directly related to what they made 2 years prior. And what I mean by what they made is what their modified adjusted gross income is. So a person turning 65, when they go to apply and enroll into Medicare, Medicare and Social Security is going to look at what that individual made in modified adjusted gross income 2 years prior. So if they're going in 2018, their Part B premium is going to be based upon their 2016 tax return. So what they make at age 63 will determine how much they pay at age 65 for their Part B premium. Were you aware of that? Most of you probably were. But what I did was I looked at this and thought, wait a minute. So this is a lot like the under 65 market, meaning what a person makes in modified adjusted gross income this year will determine how much they pay this year for health insurance. Well, the same is true, but a little different. So when a person's 63, whatever it is they make in earnings, modified adjusted gross income, that year, it's going to determine what they pay at age 65. So let's take a look at the amounts in terms of a person that makes modified adjusted gross income, what those amounts are and what that equates to and what they are responsible for on their Part B premium. So when we look here, a person that makes less than $85,000 who files an individual tax return, they will pay the standard $134 a month for their Part B premium. If this individual files a joint return and the joint return is $170,000 or less, they will pay the standard $134. If the individual files as married but does a separate return, again it's the $85,000 or less, they'll pay the standard $134 a month for the Part B premium. So what about those that make more than that? So let's take a look here at the chart, and for the sake of this discussion, I'm going to focus on an individual filing an individual tax return in these income amounts. So a person that makes above $85,000 up to $107,000 they will pay $187.50. A person that makes above $107,000 up to $133,500 will pay $267.90. A person above the $133,500 up to $160,000 modified adjusted gross income amount will pay $348.30, and anybody that's above the $160,000 will pay $428. Now, when you compare this to the previous years, those numbers were different. Actually, those numbers were a lot different. The income amounts were higher. So based upon this, you can see that they've lowered the income amount requirement on the maximum that they would pay. Before, it was around $214,000, $216,000 that they'd pay this higher amount. Now you can see they've lowered that amount. So they've adjusted the file joint return. They've adjusted these others as well. When they file a joint return, you can see here that across the board, these higher amounts. So a person that's filing jointly, their combined income levels are within these amounts. You can see what they would pay. But what grabbed my attention was that if you have an individual that files married, but they file separately, married filed separately, if their income's above $85,000, $428.60. That's pretty impactful. Now, I've got some additional charts I'll be glad to send to you. I'll give you the instructions on how to reach out to us to get more information. But let's take a look at this here. Regardless of where they fall in, they're going to be paying a certain amount. And most people, 95% of people on Medicare will pay the $134. But that 5% will be anywhere from $50 more a month to almost triple, almost $300 more a month. So how did they properly plan for that? Well, that's just one question we could ask. But what if they have a late enrollment? So the Part B late enrollment penalty, if you don't sign up for Part B when you're first eligible, or if you drop Part B and then get it after you were first eligible, you may have to pay a late enrollment penalty for as long as you have Medicare. So your monthly premium for Part B may go up 10% for each full 12-month period that you could have had Part B, but you didn't sign up for it. So wherever you fit in, or our clients fit in, if they were a late enrollee, they're going to pay a 10% penalty for each 12-month period they could have had coverage, in addition to these amounts. So let's take a look at Part D. The Part D Medicare prescription drug coverage. So under Part D, the Part D base beneficiary premium has been established for 2018 as $35.02. This amount is used to determine if there's any late enrollment penalty amounts. So what does that mean? Each year they set the Part D base beneficiary premium, CMS does, and by doing so, that's how they assess the penalties. And the penalty for a late enrollee is 1% of this base beneficiary premium times the number of months that they didn't have a Part D plan. I'm going to do a follow-up webinar here real soon, and we're going to talk specifically about Part D penalties. So stay tuned for that. But now you know what that 3502 is. That's the amount used to determine any late enrollment penalty amounts. So listed below here is going to be the 2018 Part D monthly income related premium adjustment amounts to be paid by people with Medicare who file for an individual on an individual tax return, and depending upon if they file single, file jointly, or file married and separate. But here's how it works. It's still the same income levels that we showed in the prior slide on the Part B, but being specific though, you can see that on a person, and again this is 95% of those on Medicare, that make $85,000 or less will have a zero adjustment, an income related premium adjustment amount, on top of their plan premium. But if they are in these higher income levels, 85 to 107,000, they'd pay an extra $13. If they're above 107 to 133.5, it's an extra $33.60. If they're above 133.5 to 160, it's an extra $54.20. And if they're above 160,000, it's an additional $74.80 plus your plan premium. And those are monthly adjustments. Hence the term IRMAA. It's an income-related premium adjustment amount. And it's a monthly amount. The monthly amount that's adjusted. So again, if you look at a Part B premium for a high earner that's paying $428.60 on top of whatever their MedSup premium is or their Medicare Advantage premium is, in addition to if they are a higher earner, they're going to pay this additional IRMAA amount, $74.80, on top of either the Part D drug plan costs, which would be on average $25 to $50 a month, or if they have a Medicare Advantage plan, it would be in addition to that. So the example is if they had a zero premium Medicare Advantage plan, that would include the Medicare Advantage and the Part D. This $74.80 would be in addition to that. So that's important to know. Now, under the Part D deductibles, copayments, and coinsurance, that's the amount you pay for your Part D deductibles, copayments, and or coinsurance, and they vary by plan. The late penalty, the Part D late enrollment penalty, if you don't sign up for your Part D when you're first eligible, or if you drop Part D and then get it after you're first eligible, you may have to pay a late enrollment penalty for as long as you have Part D. The cost of the late enrollment penalty depends on how long you didn't have a credible prescription drug coverage plan. The late enrollment penalty is calculated by multiplying 1% of the national base beneficiary premium. Remember that 3502 we talked about earlier? So it's going to be 1% of the 3502 in 2018 times the number of full uncovered months that you were eligible but didn't join a Medicare prescription drug plan, and you went without other credible prescription drug coverage. This final amount is rounded to the nearest tenth and added to your monthly premium. So the national base beneficiary premium may increase each year, so the penalty amount may also increase each year. So just plan on it. They go up each year. Typically, it's a modest increase, but they do go up each year. So if there is a Part D late enrollment penalty, that will be in addition to any income-related premium adjustment, just like here where we discussed. Again, I'm going to do a follow-up webinar on Part D late enrollment penalties. I'm going to break it down and show you and give you a couple case studies and to show how it's calculated so you can properly advise and guide your clients. So in addition to this side of it, you can find that this piece here we will send out to you. So now that we've discovered that 5% of people with Medicare are going to pay an income-related monthly adjustment amount to their Part B and Part D premiums. And if they get the IRMAA for one, they'll get it for both. So how do you properly plan if you're a person or a customer? How do you properly plan as an advisor for your customer to solve for this IRMAA solution, this IRMAA problem, and find a solution for it? How do you do that? When I looked at this, I thought, okay, what's my typical phone call like? I'm helping agents, guiding them on how to grow their practice, grow their business, strategies, marketing, and educating them and empowering them on building their business, right? But when I came across this, I started thinking about, beyond doing that on a daily basis, I get asked quite often, Joe, what kind of lead program do you have? Or what are you guys doing for that? What can you help me with? And typically, if you're in the senior market, most advisors or agents that sell in the senior market are looking for lead programs, and they're typically used to the turning 65 market. Understanding how IRMAA is calculated based upon a person that's turning 65 and they go back 2 years to the age 63, it makes sense to me that a conversation should start to be happening for those turning age 63. So subsequently, we have a market now that we can go to and say, look, if you're turning 62, turning 63, We feel it's imperative that you understand what you earn right now, this very moment, in modified adjusted gross income. It's going to determine in 2 years, when you enroll into Medicare, what you pay for your Part B and Part D premium. We would like to help you understand it. We'd like to explain it to you and give you some direction on it. So many people aren't aware of that until they show up at Medicare or the Social Security office to enroll in Medicare. They realize their friend's paying $134, but now they're being hit with $428 or $348 or $267. And why is that? Well, they are being hit with this adjustment because they made a lot of money, or more money than 95% of those on Medicare. So how do we help them plan accordingly? Well, there's a number of options, and there's a number of benefits in doing so. I tooled around with this and thought, wait a minute, if I could show a person age 63 how they could take non-qualified or even qualified money and start planning ahead where they could put in enough money that would give them a monthly income, the monthly income to cover their Part B, Part D, and other premiums associated with their Medicare planning, I thought, what a great idea. And if I could talk to a person turning 62, 63 and say, look, we have to plan now because what you make now is going to determine how much you pay then. And if that's true, which we know it is, then what kind of solution can we put together for them? And there's a number of solutions. You could tell them just keep putting money away in the savings account, a low interest bearing account. You could tell them to keep funding their retirement plan that's got market volatility. You could keep telling them to put money into their HSA plan if they've even got one. Most people don't fund their HSA plans. They have it for premium reduction because they want to save money on the monthly premium, but they've got to have coverage, so that's the solution in that instance. But most people don't fund their HSA plans, which that's another topic for another webinar. But what I found was that for those people that do have some sort of retirement plan, whether it be qualified or non-qualified money, I looked at what if we took out a fixed indexed annuity and we partially funded it with money from a qualified or non-qualified plan, and we took those dollars necessary that would give us enough monthly income and annual income to fund a Part B and Part D IRMAA event. And in doing so, I ran some illustrations, and I ran 2 illustrations just to give you an idea of what it might look like. So the first one is I ran an illustration with North American using their Benefit Solutions product, the Benefit Solutions 10 product, using a fixed indexed annuity, that if this person, age 63, was to take an initial premium of $105,000 that they could put into this annuity, that they wouldn't turn on the income stream for 2 years, that they would have the ability to take the proceeds from this and fund their IRMAA solution. So in doing so, I looked at this and thought, okay, if we hold on here and we take a look at what it would look like, then we could show our clients basically where they're at on their plan, and they could start generating an income. So I'm going to scroll up here, and I'm going to show you that taking a $105,000 initial premium, and we could get that out of a qualified plan through a 1035 exchange. It would pass suitability requirements, but it would have to go through all that. But when we look at this opportunity here, we could take this here, that in 2 years, we could take out a lifetime payment. So here it is, year 2, at the end of year 2, okay, of $61.87. Year 3 right here would be $63.63. That would be the lifetime annual payment amount, which is approximately $500 and some a month for that person that's at the highest Part B and Part D IRMAA level. That would give them the proceeds to solve for the IRMAA. That they could take this income stream of around $6,200 a year, turn it on in 2 years. So they're 63, they fund the annuity, they don't turn it on until they're age 65, and they use the money to do what? To pay their IRMAA. Now, is this a taxable event? Yes, I've had that question brought to me. Would they have to be in a higher tax bracket? No, it just depends. Are taxes going down? I don't know. I mean, I don't know if anybody believes they're truly going down. We just recently had a tax bill passed that it looks good for a number of people. But regardless of it, if you look at the idea of funding an fixed indexed annuity to solve for their IRMAA, it shows that it could be a pretty good opportunity, because at age 70.5 they're going to take out RMDs anyway. So might as well get this turned on and use those dollars to fund this. And the event that we'll be creating here is we're taking this annuity and helping them fund basically a medical reimbursement for themselves. And if they looked at their tax situation, we may have to increase the initial amount to make this work out favorably for them. Regardless, we're going to find a solution to this IRMAA. Now, beyond that, I've had a number of advisors say, well, there's some other options like a money market account, or how about doing a cash value life insurance policy. I like the idea of all these because we're trying to find a solution to the IRMAA problem that nobody really plans for. Most people don't plan that they're going to go in, sign up for Medicare, and come out paying 3 times on a Part D or 7 times on a Part D premium when they go into the meeting. They come out a little bit shocked. Now, in my view, if you go with the money market account, there's some benefits to that. If you look at using a cash value life insurance policy, the first thing I think of is that works very well if you've got a healthy client and they've got the means to do that, which in some instances you're going to find that to be true. If they can qualify medically and pass underwriting, a cash value life insurance policy could be the solution. But I do know that the solution, as long as it would pass suitability, would be to consider funding a fixed indexed annuity and then turning on the faucet, so to speak, of income, creating a stream of income to fund their out-of-pocket expenses associated with Part B, Part D premiums, as well as any supplements or Advantage Plan premiums that they might have by enrolling into Medicare. The other proposal I looked at was the Spectramark Flexible Premium Fixed Index Annuity. And this product here, it looked like it was going to pay out, that we do an income stream, that it's going to pay out over a little over $6,000 a year. You can see there's additional cash values and build-ups on the income base. But the bottom line is, regardless of what fixed indexed annuity you choose, you want to have one that's going to go the distance to also give them the returns that will fund this IRMAA solution. The idea behind this is we wanted you to take a look at a couple things. One is we want you to look at the truth and what IRMAA really is and understanding it, that a person's modified adjusted gross income at age 63 will determine how much they pay at age 65. So now we understand that. What's that amount? What that amount is will determine what solution we provide for them. And the example I gave was the most extreme example of the highest IRMAA amount one would pay. So what does that do for you to build out your business and to help your clients? I believe that using Turning 65 lists, doing direct mail and all that's great. It's really, really good. But I think that Turning 62, Turning 63s are an equally good opportunity, if not better, because by educating the customer on what IRMAA is and what their income in relation to what they pay for medical insurance will be, is a great opportunity for you to set the table, number one, to do this plan, possibly write and convert some annuity dollars, also fund their medical costs in the future, and that when they turn 65, you'll be the one that's already set the table for this because you've already enrolled them in the solution for IRMAA. They know they're going to be at that point, and then you're going to enroll them in their plan. And for you, by educating your customer and doing finding a financial solution to this financial problem, potentially, that you are going to not only help your client, but from a revenue standpoint, if you look at the average annuity, if it pays 6%, and you're writing a $100,000 to $125,000 annuity, you're looking at $6,000 to $7,000 in revenue. Not to mention, if you're selling the Medicare supplement and a Part D, around $350, $360 in revenue. But if you're doing a Medicare Advantage plan, and I hope you're using our win-win senior solution concept, you could be making anywhere from $350 to $1,800 in additional revenue on top of the annuity sale. So you're talking about a $7,000 to $9,000 income opportunity. And for every client you can save money by strategizing this IRMAA solution, that is a client that will help you right now. By you solving their problem, they're helping you because you got revenue coming off that. And then going forward in a year and a half to 2 years, you've got an additional sale and you're solving an additional situation for your client by enrolling them into their plans. I'd like to explore this further with you. I would encourage you to reach out to me and contact the Agent's Advisor. If you want, feel free. You can email us at info@theagentsadvisor.com. You can call us toll free at 877-886-4829. Talk to us. We can help you strategize a plan, do some case development, but more importantly, dial in and get empowered by this kind of information. We're going to send out a follow-up to this. Be looking for in your emails for that, and we'll have some additional pieces there for you. And I hope you found this useful and somewhat informative, if not very informative. And we always appreciate having the chance to share with you ideas and concepts. As always, thank you. Thank you for visiting the Agent's Advisor, theagentsadvisor.com. My name is Joe Morris, and I look forward to talking to you next Tuesday. Make it a great day.